All right. All right. You ready to have some fun, Matt? Let's do it.
Absolutely.
So, hello, everyone. Good afternoon. I'm Andrew Rosen, one of the partners here at Diversified Lifelong Advisors. I'd like to welcome you to our next installment of our Wealth Webinar Series, Understanding the Mortgage Market, with our co-host, Matt Lieberman, who is a mortgage broker professional at Apex Home Loans and a good friend of Diversified, part of our strategic alliances. Per usual, a couple of housekeeping things. We will keep this about 30 minutes so you can get on with your day. This will be recorded. If you do and shared later, if you do have questions, please type them in. I will hopefully have time to get to them and ask Matt questions along the way. And any personal questions to your situation, of course, feel free to email myself, Dave, or Kyle on the side, and we can take care of it and help you out any way we can. So without further ado, Matt, we're going to get your, let's see if we can get your presentation up here. And so you can start your fun jazz for us all. All right. Kelly, how are we looking on the presentation piece?
Almost there. Sorry, guys.
All right. Kelly is getting us situated.
Andrew, while we wait, I just want to thank you and the Diversified team for having me be a part of the your webinar series. I really look forward to adding some value and giving some information today that everyone can kind of take away and hopefully gain some additional knowledge on the mortgage market and how things work and how to build wealth through your home.
Yeah, and for those that don't know, Matt has some pretty cool resources and technology to help analyze the viability of refinancing and if it makes sense for you and where the break even is. And while we're waiting for the official presentation to load, let's talk about what's happened in the mortgage market, because I know people have locked rates or talked about rates a week or two ago and they come back to me and things are moving at rapid rates. So talk about what and why, could you?
Yeah, sure. It's always, interest rates are always a hot topic, but especially now, we're seeing so much movement, kind of say expected and unexpected, just based off of where the economy is during this pandemic. So basically, to kind of back ourselves up to pre-pandemic, rates were really, really low. We were, floating in the mid 3%, really historically low. A lot of it had to do with our relationship with China. A lot of things that seemed like a long time ago, not as much in the forefront as they were then. But then when the pandemic hit, rates just fell like a rock. As you can imagine, rates are tied a lot to economic stability, and with a lot of just unknown in the future with the pandemic and how COVID was going to affect the world. It really just created rates to just drop like I said, drop very, very fast. And so during that period of time, during all of 2020, we saw record low rates in the 2% oftentimes on 30-year fixed mortgages. And then about in early February, we saw a kind of a reversal. And normally when we see, and I'll tie up this comment here since the presentation's up, but normally when we see a big increase in interest rates, it's usually tied to an actual economic event or something that's happening specifically. But in this case, there was nothing specific that happened. It was really just the fact that there was, which I'll get into in a bit, some inflation fears and really the fact that a lot of economists think that the economy is going to pick up and regain strength sooner than maybe initially expected. So that's the main reason why where rates are where they are now. Again, still historically low. So now that we have the presentation up, I want to kind of dive in to this. Andrew, is there anything you wanted me to cover kind of before we start?
No, I think I reviewed this and it looks like there's a lot of good information and nuggets, and I'll certainly chime in as I have questions or I see questions that come across my ticker here.
Sounds like a plan. So the agenda, what I wanted to go over today is understanding mortgage rates. Like I said, it's always a hot topic, but especially now. What are some of the indicators that make rates go up or down? And it's amazing the fact that rates not only change daily, but they change intradaily. So really have to be on the lookout there. Well, where are they headed, up or down? It's always a good question. So we'll look at some trends and seeing where they were from the beginning of the year to today. We'll go over some refinancing strategies when it makes sense for folks, whether or not you look at no cash out options, just bettering the actual interest rate on your mortgage versus maybe taking out some cash for different reasons. We'll look at various terms when it makes sense to look at a 15-year term versus maybe a 20 or a 30-year term. And like I said before, when and why you should consider refinancing. The purchase market is also incredibly strong right now. We're seeing the housing market, the hottest it's really ever been that I've seen in 18 years. We're seeing a lot of people buying vacation homes, second homes at the shore or the beaches or the mountains. I think a lot has to do with COVID, what's going on. People can work from anywhere. People have some disposable cash and see the market doing so well in homes. So seeing people purchase a lot of it rental or income producing properties. So we'll go over some of that and just how impact on interest rates can affect your purchasing power.
Awesome.
Great. So understanding mortgage rates. So it's such a hard thing to pinpoint, the interest rates. First off, the biggest question I receive I see on a daily basis is, hey, what's the rate today? What's the rate? And it really depends on a lot of different characteristics. So when somebody asks me what the rate is, I oftentimes will give them a range because there's a lot of different things that make an interest rate go up or down based off of somebody's financial profile, how much money they're bringing down, their credit scores, their debt to income ratios, the type of property they're buying. Just this is a few examples. So interest rates in general are a very difficult thing to pinpoint, but I normally are able to give a range. So what is it that really drives them on a daily basis and also just overall? Really, the biggest thing is economic news. Really, when we look at rates historically, when there's good news for the economy, it usually bodes bad for interest rates, because the idea is that investors, when things are economically favorable, investors will put money in stocks and not put money in bonds, which is the main driver of interest rates. So the bond market is what drives interest rates. So mortgages are traded, they're called mortgage-backed securities. Not to go into too much economic detail, but it's the way that rates are traded. So, or the rate what drives rates. So the biggest fear that we're seeing right now is inflation. We're seeing a lot of money being pumped into the economy. Due to the stimulus is. We're seeing a lot of perceived economic growth. The stock market's doing really well. We're seeing maybe faster growth than we might have thought previous. So inflation is probably the biggest driver that we're seeing, and really the rationale behind that is that when investors, if you're investing in bonds, you're of course looking at a longer term investment. And if your money is going to be worth less over that period of time, of course you may not want to go into bonds. So bonds are really the arch nemesis, or inflation is really the arch nemesis of bonds, and that's what really has caused interest rates to increase recently. And then lastly, worldwide events. That's another thing that drives rates. What happens in Europe, Brexit was a good example from several years ago. That really impacted rates. and just anything that's happening worldwide that could cause the economy to change here in the US. And then short-term versus long-term rates. This is another great question I receive often. We noticed in the media that whenever the Fed meets and they quote unquote drop the rate or increase the rate, they're not increasing or decreasing mortgage rates. The Fed has no influence off of long-term rates or long-term bonds. Short-term rates are going to be items like home equity line rates or second mortgage rates, credit cards, student loans, car payments or car loans, those types of loans. So when the Fed reduces the rate, they're reducing the overnight borrowing costs for banks for the short term, which inherently will create rates to go up or down from there. Now, one indicator that we often use in mortgages is the 10-year Treasury note, and that is not tied to mortgages. However, it's a good indicator of where rates are going, or it really shows the trends. So if you look at the 10-year Treasury graph compared to mortgage graphs over a long period of time, you'll see similar trends. However, they do not go necessarily hand in hand. We've seen some strange things lately where the 10-year Treasury's gone up and rates have gone lower. So it's not an exact direct correlation.
Matt, question
Yes,
for you.
please.
If someone's trying to self-educate themselves because they're thinking about either buying a home soon or a second home or refinancing, is there publications or websites or blogs or anything of that nature that you as an industry expert rely on or lean on to say, hey, this is a good resource to get a sense of where things are heading?
Absolutely. There's one publication in particular that I really like. It's called mortgagenewsdaily.com. So you can just Google that and it'll pop up. It's got some fantastic articles that are live, that are written literally the day that day. So they're always current. Oftentimes I see the media lag in a lot of different areas around the industry and around the markets. So the media says, oh, rates went down a lot last week. And then I get a call, even though rates actually went up the week before, and I have to explain that. So it's really good if you're going to be self-educating and looking at data, go to trusted sites like mortgagedailynews.com. And I think that's really important as opposed to just Googling mortgage rates, because a lot of times, like I said, the media lags often. And furthermore, like I said before, a rate isn't just an interest rate isn't just an interest rate. It really depends on a lot of different financial characteristics of the actual profile of the.
Yeah, and I've ran into that before, where even when you Google it, it's a teaser rate, or it's not relevant. You got to really read the fine print there because it's not relevant to you.
Exactly. They might be doing rates off of a primary residence when you're buying a second home or an investment property where they're going to be completely different. So it's always good to talk to a mortgage professional if you're really trying to get an idea of the actual true rates, even though the rate that could be quoted could be different later that day. All right, so this is a great chart. This is a chart that actually we updated this morning. So this shows you what the trends are from the beginning of the year through today. So I've been saying rates have been going up, but you're seeing on your screen that it looks like, hey, rates have been going down. Well, it actually works kind of the opposite of what you think. So like I mentioned before, mortgage-backed securities are traded. So when mortgage prices fall, when the price of mortgage bonds fall, rates go up. So that's kind of what you're seeing here. So in January, we saw rates pretty much the lowest we'd seen them in a long time. And as you see, early February through really the end of February, we saw it's kind of like a cliff. We just saw a lot of inflation fear and a lot of things that drove rates higher over that period of time. So, rates went up maybe 0.5% to 0.625% over that period of time. We look at it and we say, gosh, rates are at, in the low threes or not in the twos anymore. It's a hard pill to swallow when you're used to seeing that. But when you look at it from a historical standpoint, these are still incredibly low rates. And just a year ago, right before the pandemic, that's about exactly where we were. So it's all relative, right? All right, so refinancing, of course, has been a super hot topic over the last couple of years. Of course, mainly due to the fact that borrowing costs are so low. So, what are some of the reasons why people consider refinancing? Of course, the most obvious is to improve the term of your loan. So, say you're in a 30-year loan and you bought a house in 2018 and rates were at kind of recent highs. I've helped people who bought in 18 who refinanced 2 or 3 times since then. So again, that's the most common in these recent years when rates have been so low, is bettering the term. But there are other reasons to consider refinancing. Because costs are so low, maybe it makes sense to take cash out to consider renovation. So not only could you improve your interest rate over time, but you could also pull out cash and still end up being in a similar cash flow position as you are today. So we're seeing a lot of that, especially during times of COVID, where people are spending a lot more times at home. I'm seeing a lot of people taking cash out of their homes to do renovations and such to better their living space. Taking cash out, whether or not it makes sense, people take cash out for really a variety of reasons. Whether it's to consolidate debt, we're seeing a lot of that right now. Consolidate debt, pay for school or college, and in general, it oftentimes is going to make sense to get money out of your house as opposed to borrowing from your investments, because of course there's, as Andrew and your diversified partners can also explain, there's a lot of tax implications when you maybe liquidate investments as opposed to borrowing that money, and you're borrowing this money at such a low rate that it's usually going to be, or oftentimes going to be, the best option. And then whether the term of your loan. A lot of times I see people go from a 30 to a 15 to a 30 and back. It really depends on your financial situation. Is it bad to have a mortgage? That's a consideration that you might want to discuss with your diversified advisor. Because the costs are so low, why not keep additional money in investments as opposed to paying off your mortgage? I understand there's definitely a big peace of mind aspect of it. We don't want to have a mortgage and have that debt, but at the same time, instead of spending the money that you have in investments, you might want to possibly keep that in investments and have that gain for you. And you're going to be borrowing money at such a low rate compared to what the market's yield right now is, that you'll just make out oftentimes better by having a mortgage.
Matt, two questions for you. One, kind of on your previous slide that came in, which is how will the Treasury auction of the $183 billion of notes impact the bond yield and mortgage rates? So answer that, then I'll ask the second one on the.
Sorry, could you go back to the one slide? Just 1 sec. Sorry, 1 sec. I just want to make sure we're on the right one. Andrew, I'm sorry. Would you mind repeating that question?
Sure. How will the Treasury auction of $183 billion of notes impact the bond yield and mortgage rates?
It all depends on the appetite for those bonds. If we see a low demand, it could really cause rates to go up quickly. If there is an appetite, if the investors see the yields being appetizing and wanting to buy into them, you could see a little bit of an improvement. So it really just depends. The auctions are really important to the direction of bonds, and auctions often happen at middle of the day, which can again affect rates differently in terms of what the rate could be in the morning, then the auction happens, then what the rates are in the afternoon.
Got it. And then more to your previous point on refinancing, is there and I hate and love at the same time, rules of thumb? Mm-hmm. Is there a rule of thumb that if rate, and I've heard different things out there from a financial planning standpoint, but Curious from someone who does ungodly amount of loans and refinancing here, where you say, or even personally, if it drops this much, it's generally a good idea to at least heavily consider.
Yeah, the most common quote unquote rule of thumb I hear from people is, oh, I want my rate to drop at least 1% for it to make sense for me to refinance. I don't really understand the logic to that. I think it really depends on the person and what savings means to each individual person. For some people, a $300 monthly savings is really important. For others, maybe that's not as important, and they might not see benefit unless they're saving $500 a month. So I think it really just is going to depend on the actual individual who's borrowing. And oftentimes if you're looking at just a rate and term refinance, you're looking at just the rate, but oftentimes we look at the whole picture, what's going to be coming in the future. And so we want to make sure we stay ahead of that and make sure you're in the best financial position at that time in the future.
Yeah, makes sense. It's not sort of what we preach here, which that jives, which is nice. And as I stated earlier, you have some pretty neat softwares that can help really ascertain and understand the savings and break evens, and if it makes sense. So
yeah, thanks so much for bringing that up. The Mortgage Coach software we use is incredible. So I'll take somebody's current loan and just compare it with a couple of different proposed options, and the numbers are super straightforward and simple, and can really show based off of the actual hard numbers as opposed to guesstimated or estimated interest savings over time.
Absolutely.
Okay. So on the purchasing side, gosh, this has been a crazy, I don't know how long now, maybe a year. We're seeing such high demand in the purchase market. And that's of course due to low rates and also such low inventory. So we're seeing it, I lend in about 10 states, and it's not just where you're located, it's everywhere. The inventory around this country is just super low. And I think a lot of that has to do with COVID. People are just not moving as much right now. But as time, hopefully as the year goes on and people are vaccinated and people are feeling more comfortable, hopefully we'll see the markets open up a little bit. So there's three different ways of purchasing a home. You can buy a home as a primary residence, which of course you're gonna live in. You can buy a home as a second home or vacation home. Or third, you could buy a home as an income producing or rental property. So those are all, those three different ways of purchasing a property all have different characteristics in terms of how you qualify, and then also the interest rates. So when you're buying a primary residence, you're going to get the easiest qualifying, and you're going to get the most prime rates because, of course, that's the house you're going to live in. That's the roof over your head. So the risk factor on a primary residence is much smaller than, say, a house you're not going to live in. That's the last thing you're going to stop paying if you're having trouble. Second or vacation homes, we're seeing a lot of these, especially recent due to COVID. We're seeing a lot of people buy homes in second homes on the shore or the beaches. I'm also doing a fair amount of vacation homes in Florida right now, where the market is also very hot. And then third, people are purchasing properties for rental income producing reasons, and seeing a lot of people doing like Airbnbs even. You got to be careful with that because there's a lot of restrictions, and you want to make sure you talk to your CPA and such before you go into buying a short-term vacation rental. But what we're seeing now with interest rates on these different types of ownership is in the last month, Fannie Mae basically announced that they would only hold 7% of their total portfolio for homes that are non-owner occupied, whether they're second homes or investment properties. And so what that basically means is that lenders all of a sudden had to kind of scramble because we don't really know what 7% of Fannie Mae's portfolio is. So essentially, as a result of that, rates recently increased a lot on these types of properties, more for the investment side, because of the fact that there's a lot of unknown in terms of what Fannie Mae is going to actually purchase from lenders. So lenders, to be proactive, just for the short term, increase their rates just to protect themselves for future potential issues with selling these loans. So it's an ever moving industry. There's constant announcements that throw us through loops. So what I always say in terms of, whether it makes sense to, kind of going off a little bit on a tangent here, but whether or not you want to lock in a particular rate at a specific time, I'm a big proponent of going ahead and locking it in, because things could change, rates could not even go up, and you could end up being priced out just because of a change in the industry. So
how long does a rate lock usually work? And
that's
what
a great
happens?
question. So on a purchase, you need to have a contract in order to lock in a rate. So if you're just out there looking, you're just floating with the market. On a refinance, you can lock in right when you decide that you want to lock in, because of course you already have that property address. Lock periods are good for as long as we need to close. So standard lock period for, say, a purchase is 60 days. Every 15 days less that we need to protect the rate, the pricing might get a little bit better. The idea is that the longer we have to protect that specific interest rate or loan price, the more expensive it is to hold that, because we
You're
get
exposed.
hedging costs on that money.
And what happens, Matt, if the rates drop? So I lock with you at 3% and it's 60 days out, and now I'm kicking myself because it's 2%, right? I don't want to cancel with you, but I do want to cancel with you because I want to get 2%. So
yeah, it's a little bit of a tricky situation in those cases. We do offer a one-time float down option, which basically means that if rates do drop significantly during the refinance or purchase process, we can one time lower your rate to get much closer to where the market is. It gets a little complicated due to hedging costs and breaking locks and costs to do that. But in reality, it's I always say, if you're comfortable with the rate and you're happy, go ahead and lock it. And if rates improve for any reason, we'll see what we can do. But of course, you're always protected for them going up during that contract period.
Right.
All right. So the next, I just want to kind of go over what to expect when you're looking to buy a house. So what you're going to need. Upfront costs. What are the normal upfront costs you're going to need when you're going to purchase a new home? There's really not a whole lot of upfront costs, which is nice. You'll need you'll need an initial deposit for your contract, and that can be really whatever you want that amount to be. That's kind of your good faith deposit. And then you'll need money for any inspections that you might have, any home inspections or radon inspections or structural things of that nature. And then lastly, you'll need the money for an appraisal. So those are really the only costs, and everything else is really paid for at closing, including your down payment and closing costs. And so oftentimes people will use their investments to qualify, or not to qualify, I'm sorry, to purchase their home. So you'll want to talk to your diversified advisor early on in the process to figure out where those funds are going to come from. You want to make sure that you guys take a good hard look and make sure they're coming out of the right accounts, which of course Andrew and the partners can of course advise on. So I think that's really important to know. And what are the things you might want to get prepared? These are very, very general, but just wanted to touch on them just so you guys are aware of what you might need, whether you're purchasing or refinancing a home. If you're salaried or hourly, we're typically going to need 30 days of pay stubs and 1 to 2 years of your W-2 forms. So pretty easy there. And if you're a variable employee, if you're hourly, we oftentimes have to average your income. So during COVID, as you can imagine, people in the service industries might have had challenging years. And so, unfortunately, we're still required, even though it was kind of an anomaly, to still average out that income. So it's one of those kind of quirks that we need to all be aware of. Right. And then if you're self-employed or commission, we need typically a lot more, especially during the pandemic. As you can imagine, a lot of companies had some hard times, and so we need to really analyze anyone who's self-employed and do our due diligence to make sure that the company is stable and will perform in the future. So we'll often need, of course, not only business tax or personal tax returns, but business tax returns, K-1s, profit and loss statements, and then really business bank statements, oftentimes to even match up with the profit and loss statement. So it's gotten really, really strict when it comes to being self-employed and buying a home.
Yeah, and what I can comment here is that don't shoot the messenger, right? In the sense that when I got my first mortgage and home in the early 2000s, it was actually with Matt, and he asked me, "What do you think you'll make this year?" I was like, "I don't know, say $100,000." And he goes, "Great," and I got a mortgage, and that was essentially it. And then these days, it's because of the mortgage breakdown in 08, 09. Federally, they are required to take a lot more information, and it's not the broker's fault or the mortgage lender's fault. It's more the regulations behind the scenes. And so even I get frustrated anytime I've refinanced or bought because it feels so intrusive, but I understand it's not Matt's fault. It's the fact that we're trying to avoid another global meltdown.
Exactly. And mortgages are all guideline based. We need to be able, even if a lender isn't going to sell their loan, they still want the ability to sell it in the future. So because of that, guidelines are really standard lender to lender. They're really Fannie Mae, Freddie Mac, FHA, VA, all standard guidelines. There are, of course, interpretations of the guidelines, but for the most part, everyone should sort of be following the same rules and kind of have an even playing field on that end. There are some non-traditional mortgages out there that are not sold to Fannie, Freddie, or the government, but those are kind of few and far between. And so in some cases, that's not, but 99% of the time, that's going to be the case. So, and then lastly, I wanted to just kind of go over kind of characteristics of what to look at for a lender when you're in a position that you might need lending services. So you really want to look at whether or not the company is local or a national brand. And what I mean by that, and that kind of goes along the lines of the next one, which is call center versus personal mortgage banker. If you're calling just a call center, whoever's servicing your loan, say it's Wells Fargo or one of the big servicers, if you call into their 1-800 number, you're going to get to some random person who's just taking information, as opposed to when you call an actual local lender, you're oftentimes going to get somebody that's going to really advocate for you. Look at everything from a holistic view. Talk to your advisor through the different strategies and work together with them to make sure you're on the best plan possible. Reputation, I think online reviews have really taken over and are super important. In-house versus outsource, whether or not you typically would want to get a company that's going to be holding all of your information in-house, underwriting, processing, closing everything, as opposed to being outsourced all over the country. And then just years in business experience. And then if they're independently owned versus national, a lot of times when you have individual owned, you're not going to have as much of a bureaucratic atmosphere, and you can get things done a little quicker and more smooth. So
that's awesome. So Matt, I think we have time for probably one final question to keep us on time. So I know you hate the question, but in your sense, do you have a feeling where rates are going in general? Are they going up? Are they staying flat? And let's talk the next 3 months, 6 month time period.
Yeah, like you said, it's a really hard question to answer. But what I will say is since we have seen kind of that sharp increase in rates over the last month and a half, we have seen some stability over the last maybe week or two, which has been encouraging. What I will say is I think a lot will have to do with when Q2 numbers are released. I know that's not going to be for a few months now, but I think that's going to really show the direction on where, when I say numbers, I mean economic figures, GDP, just all other economic numbers. That is really going to be very telling on the direction of rates. If it shows that we're not growing as strong as we thought we were, then I think we're going to see rates come back down. I really do. If there is a lot of economic stability and growth, then we might see rates suffer a little bit. But I really don't think that rates are going to skyrocket. I don't think we can, as an economy, afford that. And just because I believe that this pandemic is going to be a long-term fix in terms of from the economic standpoint. And I think that we will stay in a relatively low rate environment, at least for another few years.
Okay. So buy all your homes in the next few years.
Right.
Well, Matt, thank you very much for your time and expertise today and your continued help servicing our clients, being a important partner of ours in delivering everything you need to achieve lifelong happiness and wealth. And for those who have any questions, don't hesitate to shoot us an email. We will be sharing this with you through our normal mediums. If you want us to share with anyone specific, let us know. We can send it to them directly. Again, I'm Andrew Rosen, one of the partners at Diversified. As always, stay wealthy, stay healthy, and stay happy. Take care and be in touch. Bye.
Thanks so much.
Thank you.